Hello, everyone, and welcome to another episode of the What the Finance podcast, where we talk to experts to help gain a greater understanding about what has happened in the world of finance and investing. So, in today's podcast, I'm happy to welcome back Darin Tuttle, owner and chief investment officer of Tuttle Ventures, as you can see in the background with the lovely sign. Tuttle Ventures is an investment management firm with a strategy designed to leverage fundamental equity management alongside traditional assets like stocks and bonds. So, Darin, thanks for coming back on the podcast and how you're holding up in this crazy market we've seen over the past few months.
Hey, I think we're holding up good. Appreciate the intro there, and warm welcome here from sunny California.
Yeah, I'm quite jealous. It's actually it's nice for us over here. It's about 20 degrees. That's probably winter for you. 20 Celsius. I'm not sure what that'd be in Fahrenheit.
Yeah, and for us, we work with clients in California, and then also we've started advising other advisors. So there's a lot of independent registered advisors here in the US. A lot of them are great salespeople, right? But they couldn't pick a stock if their life depended on it. And that's where they hire, firms like myself, Tuttle Ventures, to be able to look at their portfolios, give them a second opinion, and help make actionable market insights into how we see the global macroeconomic picture.
Yeah, and how have you been seeing, the macroeconomic picture recently? Obviously, the markets have been really frothy over the past few months, down. I guess since the top, it's been down about 20%, but then recently it's gone up quite a lot as well, just in a week. So how are you seeing this? And I think I'll tie in a couple of the themes that we had from the last time we spoke, right? 11 months ago. 11 months ago, we talked about a regime change in interest rates. We talked about runaway inflation that the Fed wasn't going to be able to control. We were looking at an everything bull market, right? Where it doesn't matter what you were going into, the charts were up and to the right. Now, right? Yeah. What are we seeing? We're seeing an everything bear market, right? Where it doesn't matter what you're throwing at, charts seem to be going down and also to the right. We're seeing this regime change on interest rates, where not only are we saying that we're going to be seeing rising interest rates, but we're going to be seeing rising interest rates into a recession and talking about things like demand destruction. And then we're also at the same time looking at the stock market, which is really pulling forward a lot of these negative market sentiment themes into the here and now. And so it's difficult for people to, I think, rationalize what they're seeing on the ground from an economic standpoint, and then what the stock market is doing. And they say, do I buy the dip? Is it going to bounce back up? What's going forward? So those are all top of mind right now, and kind of juggling between all of those. Yeah, and I think one thing that I was listening to an interview last night, I think, and it was talking about pension funds and some, mutual funds, and a lot of these companies that manage money for other people. They actually can't take money out of equities. Like they can sometimes it obviously depends on what their remit and what they have to do. But a lot of times they'll actually have to move it between different equities and different industries, depending on the economic circumstances. So you could say that's why maybe we've seen a massive shift away from growth stocks into maybe traditional value stocks. And we could almost be seeing it shift back. So I guess that's where we're seeing massive volatility in some industries. Could be an influence.
And I mean, you make a very great point. Some of these large institutional players, right, have investment mandates or investment policy statements, which they have to adhere to. And at Tuttle Ventures, we certainly take that into account. At the same time, we recognize that you do need to be strategic and also tactical in your positioning. So we were early into value and avoided growth stocks. That was a big winner over the last 11 months since we talked last. The second is we were able to go into a diversifying asset class called managed futures, which I'd love to talk about more. And then, I think the third is this energy play or an inflation and commodities play that we were early into, particularly related to stocks like Mosaic with potash and phosphate. Those were also a very big winner for the portfolio. And I think the combo of those three, I don't know if those are going to be the right ones going forward, but those are the ones that have worked in the past.
Yeah, and a really interesting, I listened back to our interview, and a really interesting thing that you said is when you're an investor, you're looking to, it was a sports analogy, and it's like you're looking to invest like almost where the puck's going to go. So if we look at ice skating, it's like you're looking to skate not where it is now, but where it's going to be. So that way you can meet it sort of on the move. And I guess that's the same with investing. You're investing not for what it was like 12 months ago, but what it was going to be like today. And you've been successful in that. So I guess, where do you see the next 12, 18, 24 months going? Do you have an opinion on where the puck's going to be then?
I mean, I don't have a crystal ball, right? We do model out scenarios, and based on those scenarios, we assign probabilities. And based on those probabilities, we match those or look to line those up with implied market probabilities based off of the options market and some other indicators that we look at from a macroeconomic perspective. So that's number one. So I don't know where things are going to go. But what I can tell you is, what are the trades, right? What have I been doing over the last month to be able to prepare myself for the next 3 to 6 to 12 months? Number one is I'm reducing my equity beta, right? If everybody's starting from a different position, our portfolio had a beta of around 0.75 at the beginning of the year. We're now positioning ourselves to about a 0.25. And if you remember beta, right, I might, poke you a little bit here with some of your finance knowledge, but just market sensitivity to the overall broader market is how we're looking at beta. And so that's the first one, is reducing our overall market beta. What do you think about that?
Yeah, well, that's really interesting, because normally if it's one, then it moves exactly with the market, if that's correct. Yeah, so you're actually doing it to the point where it's only going to move a quarter. If the market moves 1, it's moving 0.25. So yeah, it's only moving a quarter of the same amount as the market. So that's really interesting. So you're basically thinking that the market's it could potentially go down. So there's more asymmetric downside risk than there is upside risk. So you want to position yourself that way.
Absolutely. I think you're hitting it spot on, right? So we're reducing our sensitivity to the overall market. But as you do that, you don't want to be taking away returns, right? Or the upside potential. And so what we've been doing over time is staging in core strategies into the portfolio that are uncorrelated with the broader market, have a lower beta, but still have a positive upside return.
And would that be a lot of the unloved markets you mentioned before? So maybe commodities, energy, and those type of things.
That's right. That's right. Managed futures is one of those. We talked about last time about the volatility overlays and trading volatility. Well, we still have that as a core position in the portfolio at around 15%. What we've been staging in now is a long, short managed future strategy that's able to trade against equities, commodities, rates, fixed income, and do it on a long and short side in a way that's negative duration overall, to be able to play into this inflation narrative that we think isn't going to be going away for a long time.
So does that mean negative duration?
Yeah, so negative duration. So duration is just the overall sensitivity of a bond price to changes in interest rates. So as interest rates rise, bond prices do well. They fall. Yeah. And, you really would have to really twist my arm to buy a bond over the last 2.5 years, right? Post-COVID. I have not bought a fixed income security post-COVID, which sounds insane to most, right? However, when you look at where we are in historic interest rates, where we are with inflation, it all makes sense in hindsight, right? And so now, when you're going into managed futures are able to short treasuries that are, priced out into the future. And by shorting those treasuries, you're actually getting that inverse duration or negative duration, to where when interest rates go up, you're not having these bond prices go down, you're having the shorted future of that fixed income security actually go up as interest rates go up, which I think is a positioning that most retail investors most advisors, most asset managers are not thinking about.
Yeah, and it's really an interesting way to do it, to actually still have exposure to, this fixed income, but you're actually doing it so that if it goes up, you're making money, which is probably most likely to happen.
Right. And I wouldn't feel comfortable getting into a market like this if I didn't have some personal experience with it in the background. So in a past life, I was working on electronic trading networks, worked in the securities lending market, made a bunch of traders a bunch of money, right? They really liked me. They'd call me up, say, Darin, can you help me out with this? And I was the operations guy saying, doop, doop, doop. Sure, I'd be happy to do that behind central control. They moved me over to the electronic trading networks, and it was my job to help onboard prime brokerage clients onto the electronic trading networks that were using managed futures. So I was working in exchanges like CME, CBOE, ICE, Nordic, and I was the one that was setting all of the limits in these futures markets to make sure that traders were set up correctly and have everything that they need to be able to perform at the top of their game.
Yeah, and how would you recommend maybe a retail investor or maybe another professional who doesn't have that experience get into it? Because I know, you've actually mentioned a few of these funds. I'm not sure if they're futures funds, they've been fraudulent. I know there's the Allianz one that you were looking at in the past few years, and there's another one that you just posted about that has also been fraudulent. So how does someone look into these and understand what is happening and if it's actually legit or not?
I don't know. I mean,
Yeah.
I honestly feel like if you weren't working behind the scenes in the operations industry, you wouldn't have that level of experience. It's funny that you mentioned Allianz, and Infinity Q, I think, is the other one. There's a lot of good that can go on behind the scenes, and there's also a lot of bad. As a retail investor, there's a couple of different resources that I think would help you get started in this realm to be able to understand the positioning of the strategy. And that's from a website called trendfollowing.com. So look that up, trendfollowing.com. That has a wealth of information for you to be able to look at how managed futures have performed over different economic periods, inflationary scenarios, crisis risk alpha, all those great things.
Yeah, it's interesting. So I guess it's a bit more advanced compared to maybe the other resources out there.
And it's not so much advanced. It's just that the barriers to entry are very high, right? So futures markets are highly regulated. They typically have high frequency trading algorithms behind them. And they use things like leverage. And you're working with counterparties that like to deal with bigger institutional clients. So it's not like you can wake up tomorrow, buy an S&P 500 future and call it a day. There's steps that you have to do to be able to get onto the platform, which is why operations from a risk management standpoint was a very advantageous position to be in. Because I was able to understand all the nuances that would go into that capital market structure.
Yeah, and I guess the risk is that because there's ETFs and funds that may be easier to access now, that if people people are investing and they might not understand it because those barriers have been lowered to actually invest in it.
Yeah, and don't get me wrong, I'm not going out there and buying futures myself either. What I've done in my portfolio and the way that I've constructed it is it's twofold. One of them is finding the best in class managers based on the strategies that they run, being able to identify the short, medium, and long-term signals that they're using to be able to implement their strategies. And so far, we've picked some really great managed futures fund managers that I think would reduce your overall risk if you're looking to diversify something. And then the second is an indexing strategy. I haven't really been a big fan of managed futures and ETFs for a variety of different reasons that I don't really want to get into now. Okay. But I can if you want. But there's a managed future strategy that is essentially replicating top 20 commodity trading advisors They look at their positions a week later, a week back in time. And from those positions, there's like 60 different futures markets that they're trading, right? And then it's synthesized down into a much narrower 15 contract futures positioning. And they use some risk exposures to be able to narrow down that sample size from 60 down to 15. And then this fund is essentially just replicating those same risk exposures a week later after those commodity trading advisors have posted their positions to the regulatory exchange.
Yeah, that's super interesting. Yeah, don't worry, I won't ask you about why you don't like the ETF one. So, but yeah, as you mentioned before, you're at 0.25 beta the portfolio at the moment. Are there any indicators? Well, what indicators would have to change, or what things would have to change for you to actually flip back and go back to the 0.75? So
that's a really good question, right? Wage growth. So for me, the inflation narrative right now, central banks were trying to get inflation. They couldn't get inflation, right? They couldn't figure it out. So they just flooded the market with unlimited amounts of money after COVID. And now what do you know? We got inflation. Well, how do you think they're going to stop it? They couldn't figure it out for years to get it to the right type of inflation. So why do you think they suddenly have the elixir to be able to fix the problem, right? Or the antidote? So what I'm looking at right now is wage growth and wage growth in response to inflation. So what we're seeing in wages right now is just absolutely booming. From the latest Atlanta Fed numbers, we had a median that was around 6, I think, over a 3-month moving average. I just posted it on my Twitter. You know me, I'm big on Twitter. Yeah. And this wage growth is really a process rather than an event. And so until I see meaningful wage growth start to dissipate or turn around, I don't see the inflation narrative changing anytime soon. I personally think that we could see inflation be at these elevated levels of 3+ for at least 5 years, the next 5 years.
Yeah, well, that's interesting. Well, I actually talked to someone, Doomberg is, I don't know if you've heard of them, like
the bird, right?
Yeah, the green bird about energy. And he was saying, because if you think about like the real thing that changed, and obviously we had COVID, but there was also monetary. One of the first times we really used fiscal, basically giving people money. You use the fiscal rather than using monetary policy to, give liquidity to banks. We actually use fiscal policy to give people money, basically, all around the world, and that worked really well to stoke inflation. And we've seen that recently with energy, where in the UK there's been quite a lot of fiscal money given out through levies on electricity. They've basically given people £600 free, depending on how much you have, up to £700 free for energy. I know California's done that recently as well for petrol and stuff like that. So I guess the more this happens, it's hard to see how it goes the other way.
Yeah. And, I made a post on it. Everybody got free money, right? Like during COVID through different means, right? Whether it was, fiscal policy or rebates with some of this employment, incentives that they had to keep people employed for business owners. But what did you do with the money, or where did it go, right? For me, a lot of it went into my business, right? Starting my business, getting things up and running. I think getting a $2,000 check because you were locked inside your home and then having to deal with the economic repercussions of a recession on the back end of it, I don't know. I think time will still tell whether or not it was a success. But I do think a lot of the people that already got that money have already been spent, and it's been long forgotten that they ever even got it. So it's a helpful reminder to have sometimes, right?
Yeah, definitely. So, you mentioned that you think we could see 3% for 5 years. I guess what would change? You mentioned wage growth there, and if wages growth decrease and hopefully inflation decreases with that, fingers crossed, otherwise it'll be a disaster. But would there be anything else like that you think would have to change for the Fed to put down?
I think so. Outside of that, I don't really have a core thesis. I just have ideas. Yeah. I don't have any solutions. I'm really just trying to trade this market as best I can. I really missed, I think, the appreciation of capital expenditures. I think right now everybody's so focused on free cash flow. And I have been the same way for a long time. Free cash flow, what are my value companies producing, and how is that being paid back to shareholders? Now, what I would like to see, right, is capital expenditures through this energy and monetary transformation that we're seeing that's similar to the 1970s.
Yeah, definitely. I guess the real recession will occur when, rather than people doing capital expenditures, they save. So if you look at the massive companies like Apple, or these big tech companies, once they, and we've already started seeing it, like Amazon, they're starting to cut back. They're starting to, rather than invest in the future, looking to focus on being prepared potentially if there is that recession. And that's concerning, because that's almost a self-fulfilling prophecy.
Right. You start hoarding cash, and then what do you know? Your neighbor starts hoarding cash too.
Yeah.
But that we do like a lot of things in the market right now, both on the long and short side, right? So being able to have that ability to go long and short, I think opens yourself up to the other half of the trade, right? When you're selling, there's somebody on the other side of that trade. And being able to understand the rationale that they have for that side of the trade, I think, is what can keep you in the game longer than others.
Yeah, so not just looking at your perspective, but who's what they're thinking about as well. Why are they long and you're short?
Mm-hmm. And we're young guys, right? I mean, we're the younger generation, we're the millennials, right? So when we see stocks go down now, this to me is a generational opportunity. We've been priced out of other things, right? We've been priced out of homes. We've been priced out of being able to have an affordable education that doesn't burrow you down in mountains of debt for years on. I've done things to be able to avoid those type of situations, right? But it wasn't easy, and it certainly wasn't the path of least resistance. And so because of that, I think if we did see, a significant market correction to the downside for our generation, I think we would look at that as an opportunity to be able to get money into the market for the next 10, 20, 30, 40 years.
Yeah, and that's vital. So you think we could see, or as you mentioned there, almost like the 70s, where interest rates are really high, and then it's almost like a decrease potentially over the next 20 years or so?
Yeah, I mean, I'm holding back a little bit. I just wrote in my newsletter, I have Substack too. I mean, I'm just like the quintessential like meme here. I'm always on FinTwit, right? I have a Substack newsletter, but in my latest newsletter, I write about tightening financial conditions. And there's a Chicago Fed number that comes out weekly that measures 150 different financial indications of whether monetary policy or whether the overall financial condition is loose or tight. And what I did was I just took that on a percentage change on a year-over-year basis. So just looking at it from the baseline level of where we were last year, and whether or not those conditions were getting tighter or whether they were getting weaker. And as we tighten, or as lending and reserve balances and credit all become tighter in this type of condition, typically, if we go any tighter from where we are right now, from this last week's post, we can see an equity drop of around another 10 to 25%. And so when you get this Fed level, this Fed tightening financial conditions level of 0.5 or above on a year-over-year change basis, if you're going above 0.5, it's been the last 6 times going back to 1980. I think is the data that I have. And each one of those times that it's gone above that threshold, we've seen a downside break of 10 to 25% in equity markets.
Yeah, I think that's and obviously, not a financial advice. I'm looking, once we get down to that 25%, 30%, that's sort of and who knows if we do, I might completely miss it. But if we do get there, that's when I'm really eyeing up some opportunities for maybe, some of these growth companies that are actually, the actual real companies that are making money and are growing and are needed, that have dropped 40, 50, 60, 70% sometimes.
Yeah. So Anthony, I'm going to tell you, I'm going to cut straight to one thing here, and I'll be interested to hear your opinion because you're a smart guy and you talk to a lot of smart people. I will tell you this: there is no such thing as a technology company.
Why?
Because Google is an advertising business.
Yep. Yeah.
Facebook is social media and social status. They're selling social status.
They're advertising as well, if you think about it.
Apple is hardware. Apple's a hardware business. Everybody's got it in their hand, right? Mm-hmm. They're a hardware business at heart right now, in my opinion. I don't personally think that there is any company that can just straight away say that they are a technology business. And I think tech can often be like associated with like this .com idea too, right? Like remember in the .com boom where anybody would just say, .com and their stock would shoot up 25 or 30%. We were in a period of time where any company would say, oh, we're a VC backed technology company out of Silicon Valley doing, software that's going to change the world. Boom, $1 billion unicorn valuation, right? What is Uber? Uber is a logistics company. Uber's not a technology. They're a logistics.
Sorry, you keep going.
Yeah. No. Go ahead. What were you going to say?
I was going to say, so say like a SaaS company, maybe like a Salesforce or a Microsoft or a Palantir, what would they be? Because I guess, that they're producing code and software.
Okay. They are, I would say, a data analytics company.
Getting closer. That seems quite technical.
Yeah, that does seem quite technical, but I think here's the difference. So I've worked, like I said, with advisors. I work really great with advisors. I worked with an advisor that had no CRM, client relationship management database, right? They were just notes that they would put on a piece of paper. And every year we'd have to go find these notes. I mean, it was a nightmare, complete headache. We made the transformation to where we had a one-page dashboard. So over time, we got everybody to use Dynamics 365, which was the client relationship management database. And then we had to input lots and lots of data, birthdays, last time we met with them, the tasks that we're working on right now, assets, liabilities, investments, all of that information we just had to cram into this thing, right? And then we could have left it alone and not done anything with it. But then what we had to do was we had to then take that data, right? Link it through APIs, through a system called Power BI to create this one-page holistic dashboard. An advisor walks in and they know exactly where all their clients are standing at any given moment and what they have to do for the next day, week, month to be able to keep their business running.
So you're saying that's sort of like an example of there's still that input, that human input. So it's not specifically a technology company.
Yeah, no, 100%. And it's that data analytics that is useful, but it could have just sat there and done nothing, right? Then we had to do the hard work of extracting that data, right? Transforming it into a way that's palpable for everybody, and then loading it into a presentation software to where you're able to make those decisions. And so, that data analytics, that sorting of information, I guess could be the closest thing that you could say to technology, but in reality, it's being able to have actionable insights from that data that actually makes those companies worthwhile. Salesforce, in and of itself, right? The reason that they're so valuable is because you can have all that client information and then make an actionable insight from it and extract from it, right? But at the end of the day, you're still trying to sell somebody, or you're still trying to provide a service, right, to them. And so at the end of the day, I mean, I think technology can just be like this like blanket term that people just throw around without even really thinking about how does this business actually make money.
Yeah, and we've seen that over the past few months where people are actually starting to question it. It's like, hang on, you've said you're innovative, but you're really not doing anything more than what other industries have done. And we've, I don't know if you've realized this, but Ubers are actually more expensive now than taxis. Whereas 10 years ago, they used to be cheaper, and that's why people used them. So it's like, why are they using them? Same with Airbnbs, with all the servicing fees, they're almost more expensive than hotels.
Yep. Yeah, no, I mean, adding in technology certainly has its benefits, right? And it's able to leverage and scale. But if you don't have the leverage and scale with the right business principles behind it, if you're losing money for every dollar of sales, right? At some point in time, leverage and scale starts to work against you rather than in your favor.
Yeah. So would you say, so I'm guessing that sort of shaped your investment philosophy quite a bit, where you're more focused maybe on these companies that are potentially less loved because of the industry that they're in, and they have a lower valuation despite maybe what they're doing. Is that correct?
Yeah, no, that's exactly right. Value investing is having a call option on positive news.
Okay, expand.
So I'll just look at I'm talking my book now, right? So I need to be careful. This isn't blanket recommendation, but like these aren't blanket recommendations, right? But I have, what do I have in the portfolio? I have Campbell's Soup. I have Altria. I have Olin Corp. I have Gaming and Leisure Properties. That's a gaming REIT. And then we start going into these managed futures funds with Campbell and Grant Park, and then I got another one here of Maxar Technologies and Fortuna Silver Mines. Those are not value names; those are growth names, but they also have a part in the portfolio in a small percentage as well.
Yeah, it's interesting. So, and that I'm guessing, obviously, that's because of your investment thesis and your philosophy, but at the same time, because of what you're thinking is going to happen with interest rates, and that they're going to, they have obviously lower beta to the market potentially, and they're also going to be doing better than a lot of these other growth companies, like a Tesla that has over a two beta.
Yeah, no, Tesla. I have no opinions on Tesla. To me, Tesla is a religion. It's not a company. People follow Elon Musk as their Lord and Savior. And because of that, I don't even look at the books at Tesla anymore, because I just can't, right? But, I do love a good growth story. And one of the growth stories that I'm particularly akin to is this one with Maxar Technology. I can talk about it a little bit if you'd like.
Yeah, sure. And I know that's it's been doing quite well it's quite important during Ukraine Russia conflict, I think, and they've recently got a new deal with the US government, if that's correct. US
ministry. Yeah. So you know the company well, right? They got a lot of free advertising with Ukraine, and
maybe you want to explain it. Sorry for listening.
Yeah, no. So Maxar Technologies has a couple of different business lines. One of those business lines is satellite imagery and geopolitical intelligence. And during the Ukraine crisis, they have satellites that are commercially owned by a US-based company that then has contracts with the US government to provide intelligence at a very acute and very detailed level that may not be available to other satellites that are up in space right now. So they can zoom in, get you the details of what's happening on the ground. As long as it's a clear day, right? No clouds in the sky. They can get right into where strategic assets are on the war front, and they were really kind of showcased in the Ukraine crisis. Every news organizations, CNN, BBC, all of those were plastering Maxar Technology photos from space.
Yeah, well, I think I know in Sky News in the UK, the shocking the massacre in Bucha or whatever in Ukraine, and that was actually through the company. Well, they had side by side photos, images of what it was like maybe a day ago and what it was like on the day.
Yeah, and it's not just for war. They are having another use case here, particularly that they're trumpeting, where they're able to identify in the Amazon rainforest those that are cutting down the rainforest or having lumber operations that are illegal. And so densely, jungle environment, they're able to see, from outer space, boom, who those people are and where they're located, so that regulators can be able to go in and stop them in the act, which is pretty incredible.
Yeah, it's vital. And I think that's it's a gap in the market that can provide things that no one else. Well, I guess there's potentially other competitors that do it, but other than that, can't get it from anywhere else.
Yeah, there's other competitors. Here in the U.S., there's one called Planet. PLN, I think, is their ticker, but don't quote me on that. It takes a lot of work to get up to get these types of satellites up into space. So you need a ticket to ride to be able to go up there. So that's like one of the first obstacles. Are you going to, ride on SpaceX? Are you going to go with NASA? Are you going to go with, some other organization to get you up there? That's problem number one. And then problem number two is just the engineering that's required to be able to get such a focused image on one particular location. So, I mean, this thing is spinning around the Earth. The Earth's curved. It's pretty incredible what they do. I have no idea how they do it. But I know that Maxar has been doing it the longest, and they do have, tickets to ride up to be able to launch their satellites. And with this next Legion satellite that they have incoming, they'll be able to take 14 intraday 3D imaged photos of one particular spot in the world and be able to beam those down to you on the same day, which is, to me, just mind-boggling.
Yeah, it's amazing. That's got a pretty massive moat over $50 million just to get your technology up into space. You have to design it first and then actually getting up there as well.
That's right. Oh, so you're probably referencing my newsletter, right? In my newsletter, the Legion satellite was delayed another quarter. So they aren't launching those satellites today, but they do have it planned before the end of the year. Every quarter that they delay launching these satellites, it's another $50 million cost to the company, and that's from management's estimates as well. It could be more than that. But the backlog of orders that Maxar has is over $1 billion. And because of some accounting rules here in the US, you're not able to actually put backlogged orders or unfulfilled orders onto your balance sheet based on the way that they're reporting revenues. And for that reason, I do think that there's this total addressable market, a moat that Maxar has, and a growth story. I don't think space is going to become less important in the future. I just think it's only become more important, and you want to be, having some growth upside potential there for the long term. This is a long-term play.
Yeah, definitely. That's massive. And I guess let's pivot to maybe the complete opposite, the complete, shelter. So I know you've been really interested in housing, and I think I've been reading your newsletter, as you've said, and a recent company that I think has done quite well was New Home Company, that I think was bought out by Apollo Private Equity, I'm pretty sure. And then you've also mentioned a company called Boxabl, which I watched the video, and it's pretty crazy. It's like a company that manufactures houses in their factory, and they literally can fold them out and put them up. And I think they're saying that maybe Elon Musk has one and is using one in Texas. I think that was what they're saying. So what's your thesis on that? So are you thinking that the market's going to continue to grow and continue to be quite profitable?
Yeah. Oh, well, here's the thing. I think we're going to have to build ourselves out of a recession, right? what better than home builders to be able to do that? Home building is a tough industry, right? You have a lot of costs, and one of those biggest costs are labor, like we talked about before. So we have a supply shortage of housing across the US. So we need more builders, and we need efficient builders, and we need to be able to do it at scale. How I found New Company was actually interesting because it's right in my backyard. So it's kind of a disadvantage for me. They're based out of Irvine. They have huge development here in Corona. I was very curious on why they were not selling more than 3 homes a month in the different communities that they owned. Found out that they were trading at a less than cash on hand or inventory on hand, and based on their total market cap. So it just didn't make sense. It was a small cap company, less than 500 million. So not a lot of people were looking at it. But they were selling 3 homes a month because they were pre-selling the homes. And this was management that had experienced 2008 with the housing crash. They were overly conservative in a time when housing prices were booming, and they could have been pre-selling all 100 lots in their developments. They were only selling 3 homes a month, which was maddening to me from a cash flow standpoint, right? But they said, oh, we have this formula, and we don't want to sell all of our inventory at one point in time. And with interest rates rising, my fear was that home prices would start to depress, right? And it would kind of kill that demand for people that are looking for borrowing either their first home or buying a second home. You start to question that when interest rates are at 6 or 7% rather than when they're at 2 or 3. So yeah, we staked a position in New Home Company. Started recommending that for clients. It was taken private. I think at a 3 times multiple from what the cash was trading on hand, and around a 4 times multiple of what we staked a position on. So that was a big win for us. I think that the plan was never to get bought out by a private buyer, right? I never even thought Apollo would come in and sweep in and see the value that I was seeing with that company. But it was really just about kind of understanding the dynamics, understanding how management was viewing things, and then having this macroeconomic backdrop that we thought was a high probability outcome to be able to put together that one trade, right?
Yeah, definitely. That's massive. And now you move on to Boxabl, which is another company.
Yeah, Boxabl is an interesting one. I really want them to succeed. They have, so the family, Taramino family, terrible with these Italian names, right? But Paolo has ties to Porsches and Formula One and all these like really fast cars, right? I'm totally butchering this, but cars aren't really my thing. But he designs really fast cars, has been doing that, sits on a lot of patents for those. So he really designs like ultra sleek and fast cars, not really a home builder, right? I was curious. I said, this guy owns a lot of patents. What are some other patents that he owns? One of them was the concept of this foldable mobile home that's able to be assembled on site and disassembled. And because of that, it really intrigued me. The more I learned about the company, the more I saw the upside potential of being able to sell these affordable mobile homes that don't look like the typical mobile home, right? These are top of the line using high quality materials. A lot of design has been going into it, which, it kind of attests to Paulo's design of these nice cars in the past. And then Porsche came in and had the design for the factory of actually manufacturing it. And after I saw the Porsche designs for the factory, I said, okay, wow, like this is $100 million company. This is incredible. And as more people began to gain interest in this mass manufactured homes that can be produced at a factory, shipped on site, and then set up, it got some attention from the US government for potential for disaster relief. And because of that, this $100 million company that I was valuing based off of Porsche's factory that's based here in Vegas, became a $1 billion valuation, right? And going from $100 million company to $1 billion company, that's, I mean, I don't know. I don't know if you've ever had that experience, but I haven't, right? And to be able to do that, you have to scale, or you have to change different things for operations. And I'm not sure going forward if the family is prepared to be able to do that. But I am bullish on the idea of Boxabl, and I really do want them to succeed.
Yeah, it's almost the perfect like manufacturing background, isn't it? Cars, it's like they're so good at being manufactured. So if you could do that for housing in a similar way, that would be great. And I found it really good because it's not like, sometimes with the other trucks, you have to close down roads and, they take up multiple lanes, these massive trucks, but this is literally on a trailer, which you can just fold out.
Yep. Literally on a trailer. And I think they're looking at also adding wheels too, because transporting these, has been a very big cost for the company overall.
Yes, that's huge. So that's another thing. And as you said there, it's a way to potentially, hopefully we don't, but if we do have a recession, for the US to build its way out of it.
Yep. Building your way out of recession.
Darin, thanks so much for joining the What for Finance podcast again. We'll have to definitely do our trilogy in the not too distant future. Maybe another 11 months, then we can see if things have happened as we thought they would. But maybe what is the one message you want people to take away from our interview?
I think ultimately, if there's one thing for people to take away, I want them to be able to know that successful investing takes vision, courage, and patience. That Tuttle Ventures, what we're building here, is a way to be able to foster that for independent investors. If you're interested in learning more about, our investment strategy or how we set things up, check me out on Twitter. Visit TuttleVentures.com. Or you can tag me, on Facebook or LinkedIn. I'm on all of those. So, I'm happy to help independent investors achieve their dreams, whether that's advisors or private clients, and set them up for success.
Yeah, awesome. That's great. I'll put that all in the description below. And we've mentioned quite a few times your newsletter on Substack, which I really enjoy. Has some quite interesting insights into the markets and what's happening.
Right.
So, awesome. Darin, thanks again.
Awesome. Thanks, Anthony. Appreciate it, man.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.